Okay, now please come to the next paragraph. Exclusion of payment allocated to non-lease component. Non-lease component we have seen today in the beginning. That is those payment related to other activities other than leases. Like for example, maintenance. So entities are generally required to separate lease and non-lease component of a contract. Already discussed with you, for a lessee, lease payment do not include payment allocated to non-lease component of a contract, unless the entity, that is the lessee, has elected to combine lease and non-lease component under the practical expedient permitted under the standard, right? So if you choose for practical expedient option, then there is no need to split your lease payment into the lease and the non-lease component. But if you look at the right side, for a lessor, the lease payment do not include payment allocated to non-lease component. What is the difference in these two? There is no practical expedient option given to the lessor. Now, what do you mean by fixed payment? Because main component of my lease payment will be the fixed lease payment, okay, or in substance fixed payment. Payment made by lessee to a lessor for the right to use an underlying asset during the lease term, excluding variable lease payment, is called fixed payment. In substance fixed lease payment, underline. So there is a concept called in substance. That means they are actually not fixed in the form, but in substance they are fixed because these are unavoidable. Liability to pay is there, but the amount that you will pay may be uncertain. Which are specifically required to be included in the lease payment are payments that in form contain variability but in substance are unavoidable. That is called fixed, in substance fixed payment. Some discussion on in substance fixed payment. In substance fixed lease payment exists, for example, if payments are structured as a variable lease payment, but there is no genuine variability in those payment. Those payment contain variable clauses that do not have real economic substance. Now let us look at the example of in substance fixed payment to understand these 2 points, that there is no genuine variability or there is no real economic substance behind those variability. Example. First, payment that must be made only if an asset is proven to be capable of operating during the lease. Looks like variable. Payment that must be made only if the asset is proven to be capable of operating during the lease, or only if an event occurs that has no genuine possibility of not occurring. Only if an event occurs that has no genuine possibility of not occurring. So payment must be made only if the asset is proven to be capable of operating during the lease. So you take this machine, okay, give me the payment only if the machine operates as per your requirement. Is it fixed or variable? Looks variable. You will pay only if the machine operates, but you know that machine is going to operate and therefore you are going to make the amount. You will pay the amount. Or if, this is another example, if an event occurs that has no genuine possibility of not occurring. It may be linked to an event which is likely to happen, which will happen. 2 negative means 1 positive. Okay. Second example. Payments that are initially structured as variable lease payment linked to the use of underlying asset, but for which the variability will be resolved at some point after the commencement date so that the payment becomes fixed for the remainder of the lease term. 5% of sale? No, that is not the example. The moment you get the first sale, you start paying the lease rental. Okay. Payments that are initially structured as variable lease payment linked to the use of the underlying asset, but for which variability will be resolved at some point after the commencement date so that the payment becomes fixed for the remainder of the lease term. That is, lease payment will be made after your sales exceeds 5 lakh rupees. So then your lease payment will start. Or when you make the first sale. Okay. What is your query? Same example. Those payment becomes in substance fixed payment when the variability is resolved. Okay. That means you may have set some kind of target. Once the target is achieved, then the payments will be made. So these are in substance fixed, but looks like variable. One more, there is more than one set of payment that a lessee would make, but only one of those set of payment is realistic. In this case, an entity should include within lease payment the realistic set of payment. Which one? Last one? This first one.
While entering into a lease, if I am not sure that I will get some return, I won't consider it as a term of lease payment.
But it's
entering with that term, 10% of sale or so, I would be sure that I would recover that amount.
But 10% of sale is a pure performance based lease rental. Yes. 10% of sale means if you have sale only, then you will get 10%.
But after a certain point of time, it will get a surety, right?
But every time it is going to vary. Sale amount itself is also not certain.
Every time it is going to vary, then that.
No, this standard specifically says you cannot depend on future performance based. No, contingent rents are excluded from lease rental. That means here what we are saying, an event occurs and then it becomes a certain amount that you are going to pay. We are not telling here you that lease rental is equal to some percentage of the sale. I am saying that your lease rental will start if you exceed the sale of a certain amount, say 5 lakh, and then you start paying the lease rental.
Exceed the sale is different. Percent of sale is different.
That is what I am also saying, the same thing. Percentage of lease rental cannot be based on percentage of sale. If it is there, it is not lease rental, then it is some other expenses charged to P&L account. It is purely based on future revenue performance. Is it right? Revenue performance based lease rental are not in substance fixed payment. That was mentioned earlier also. Revenue based, it's linked to revenue. Then this example, understand point number 4. Now here the point number 3, this point says payment that are initially structured as a variable lease payment linked to the use of the underlying asset, but for which the variability will be resolved at some point after the commencement date, so that the payment becomes fixed for the remainder of the lease term. So I said that maybe they will say that once you achieve a sales of some amount, or once your first sale is made, then you can start making payment for the lease payment. But what this student is asking, if the variable rent is 5% of sale, then it is in substance of fixed payment. That is not the case here. But if it is like this, for example, third situation, there is more than one set of payment. 5% of sale or rupees 1 lakh. Okay, whichever is lower. Whichever is, or let us say this is the minimum, or rupees 1 lakh minimum. In this case, 1 lakh will be considered, but 5% of sale will not be considered. When there is more than one set of payment that a lessee could make, but only one of those sales payment is realistic, In this case, the entity should include within lease payment the realistic set of payment. So if it is 5% of sale subject to minimum rupees 1 lakh, then we will take 1 lakh as lease rental.
So, but then how are we going to classify that 5%?
That is not a lease payment.
But then how we
It is an expense. When you pay it, that answer will come. Your question will be answered in the some paragraph. In such cases, when it is linked to some kind of variation, then whenever that event occur, you calculate and treat it as an expense at that time. Expense related to service that you have received.
that is not the service.
That is a service. You are using a mobile phone, that is also a lease rental. Telecom license you are using. You are using a bus service. Is it not a lease? That is also a kind of, if I go by your logic, but then it is a service. You charge it as some point of expense. You can name it, na? In substance fixed payment, there is more than one realistic set of payment that a lessee could make, but it must make at least one of those set of payment. In this case, an entity should include within lease payment the set of payment that aggregates to the lowest amount on the discounted basis. If more than one payment is given, take the lowest amount on a discounted basis. This standard requires a lessee to include in substance fixed lease payment in the measurement of lease liabilities because those payments are unavoidable and therefore are economically indistinguishable from the fixed lease payment. Why do we need to calculate lease payment? Because we have to compute the present value and then account the present value as an asset and as a liability. Okay. Now lease incentive, meaning as I told you, sometimes the lessors what they do in order to get a new customer, some form of incentive are given. So we will first check whether there is any lease incentive. It should be associated with the lease. It should be associated with the lease or the reimbursement or assumption by a lessor of cost of the lessee. So payment made by the lessor to the lessee associated with the lease or the reimbursement or assumption by a lessor of the cost of the lessee is called lease incentive. Our earlier standards did not discuss lease incentive in detail, but this standard brings lease incentive also in the calculation because of increasing trend of giving some incentive to get the customer. So what are the example of lease incentive? An upfront cash payment to the lessee or a reimbursement or assumption by the lessor of the cost of the lessee. For example, relocation cost, cost associated with a pre-existing lease commitment. Now sometime if you get out of the previous lease, you have to pay some compensation to the previous lessor. This new lessor says, you don't worry, we will pay that amount, right? That is also a part of lease incentive. Such payments are offset against lease payment made by the lessee to the lessor. Should it be treated as income in the P&L account or should it be deducted from the lease payment? Yes, so that can be a question for you. When an incentives are paid to the lessee, even if they are not part of formal lease agreement, they should be offset against the lease payment, underline. Because they will give you a question and then some student will think that, oh, it is an incentive, P&L account. Adjust it and then calculate, okay, your lease payment, etc. Now, what is variable lease payment? The portion of payment made by the lessee to a lessor for right to use an underlying asset during the lease term that varies because of changes in facts or circumstances occurring after the commencement date other than the passage of time. Variability arises if lease payment are linked to. Now, what are the lease payment? A variability can be due to price changes due to change in market rate or the value of an index. For example, lease payment may be adjusted for changes in a benchmark rate or a consumer price index. This will be considered as a lease payment. Variable lease rental linked to either an index like consumer price index or a benchmark rate like LIBOR will be considered. Okay. How to do the calculation? We will see one example soon. Okay. This example we will take where there is a variable lease rental. Two examples I am going to solve, one based on index and one based on benchmark interest rate. This will be considered, and then if they change, again how do we do the calculation? That also we will learn, because it will change every time. Today we will assume something, then next year it will change. So the standard gives you detailed guideline on how to solve question of benchmark interest rate or consumer price index and how to deal with the changes. Next is lessees performance derived from the underlying asset. For example, a lease of retail property may specify that lease payments are based on a specified percentage of sales made from that property. Right? Not to be considered. Because this is contingent on sale. This is not contingent. There will be some index every year. There will be some benchmark rate every year. And third is the example of use of underlying asset. A vehicle lease may require the lessee to make additional lease payment if the lessee exceeds a specified mileage. This exceeds the specified mileage will not be covered. Okay, only first you will calculate based on agreed mileage. After that, if it exceeds, then we will account it separately. Right now, for calculating the amount to be capitalized, this will not be considered. Variable lease payment that depends on an index or a rate should be included. Okay. For example, already discussed consumer price index, benchmark rate like LIBOR, payment that may vary to reflect change in market rental rates. So we'll take problems on these points in the next page. You will see when measuring a lessee's lease liability or a lessor's net investment in the lease, such payment should initially be measured. Underline. This is your query. How do we do the calculation? Such payment should initially be measured using the index or the rate at the commencement date. Okay. So on day one, how do you do the calculation? If it is based on a price index, we have that figure available. If it is based on a rate, that figure is available. And then of course this will be changing also. So I will tell you in the subsequent slides how to account when they change. Now if it is based on percentage of revenue, then you will have to do the calculation on the basis of estimation. And then it is very difficult. This standard is not entering into, remember, a lot of complicated areas where a lot of estimation will get involved. So revenue based means this initial recognition will become extremely difficult if it is a 15-year lease. Okay. You can't estimate your income for 1 year also. Do you know that? Can we estimate? When you file your advance tax return in the first quarter, you estimate this is the income. By the time you reach the fourth quarter, altogether every figure has changed. Next point, why variable payments that depends on an index or a rate are included? The answer is these meet the definition of liability. for the lessee because they are unavoidable and they do not depend on future activity of the lessee. Only thing is amount may not be certain, but the liability is certain. Therefore, we make the provision. Any uncertainty that relates to measurement of the liability that arise from those payments and not to the existence of that liability. So here what they are saying, it is like a provision. Amount is not certain, but the existence of a liability is certain. Now please mark one important question. So solution is also there. Try to understand. This can be a question for exam purpose also. Keep the calculator ready. A lessee enters into a 10-year lease of a property. Okay. So number of years are 10. With annual lease payment of 50,000 payable at the beginning of each year. Be very careful with this beginning or end. Beginning means you will pay first in year 0, then 1, 2, 3, 4, 5, 6, 7, 8, 9. These are the payment dates. So first payment will be made today only, 50,000. The contract specifies that lease payment will increase every 2 years. Lease payment will increase every 2 years on the basis of an increase in the consumer price index for the preceding 24 months. The price index today is 125. This example ignores any initial direct cost. Very good. The rate implicit in the lease is not readily determinable. That is for discounting purpose. The lessee's incremental borrowing rate is 5% per annum. So this is similar to your previous standard on lease. If you cannot find the implicit rate in the lease, then you apply lessee's incremental borrowing rate of interest, which reflects the fixed rate at which lessee could borrow an amount similar to the value of the right of use asset if in the same currency for a 10-year and with similar collateral. They could have simply written incremental borrowing rate is 5% for discounting purpose. Anyway, at the commencement date, the lessee makes the lease payment because first payment is to be made now at the beginning and measures the lease liability at the present value of the remaining 9 payment. Now you will have to take a calculator. First calculate the factor for 9 year, annuity factor. So I will tell you how to do it. 1 divided by 1.05. If your calculator has the GT function, press 9 times equal to. And after that, you press GT function. And then multiply by 50,000. Is it right? Approximately, are you getting 355,391? Yes. So this is basically 50,000 into present value annuity factor 5%, 9 periods. Okay. In the exam, you'll have to calculate it for day 1 accounting. So what is the accounting on the first day? Now this standard says you will have to account on day 1, initial recognition, the present value of lease payment as an asset and as a liability. Present value of all lease payment, which we have seen 5 items in the lease payment: fixed payment, in substance fixed payment and in substance fixed payment, and then your option to purchase, option price, then your residual value guaranteed by you, and termination option if it is certain. 5 items, minus any lease incentive. So in this question, you don't have lease incentive, you don't have option, payment, guaranteed residual value, termination option, etc. Only basic fixed lease payment. Okay. Which initially is based on 50,000. So tell me the journal entry. You will open an account in the books of lessee, which we will call right of use asset. ROUA. Okay. Right of use asset. Debit, how much? You have paid this amount today and this amount is payable. So to begin with, my total amount payable is 4,05,391. 4,05,391. So asset will be debited at the total amount payable in present value terms. 4,05,391. And then you have paid 50,000 to cash. You have to pay 355,391. So to liability. Now what we will do, every year we are going to calculate the interest on this amount. We are going to provide depreciation on this amount. Is it right? Let us read further. Lessee expects to consume the right of use asset future economic benefit evenly over the lease term and thus depreciates the right of use asset on a straight line basis. So if suppose you are asked to calculate depreciation, how much depreciation he will charge per annum? You have to take this number, divide by how many years? 10 years. Payment is made 0 plus 9, but actually period is 10 year. So what is depreciation per year? 4,40,539 per annum. How much interest you will provide on this 355,391? 5%. So 355,391 and interest at the rate of 5% is how much you said? 15,000? Not 15, more than 77?
1,770.
Is it right? Okay. And then come back to this question. So this is the interest you will pay in the first year. Interest in the first year. I will keep that in mind. Lessee expects to consume the right of use asset future economic benefit on a straight line basis, we have discussed. Now, dear student, when will the lease rental change? After 2 years. After 2 years. After 2 years, they will again reassess the lease rental based on consumer price index at that point of time. Okay. So in year 0, 1, 2, interest of this year we have calculated. Okay. Then I will pay one more installment here and I will calculate the interest of second year. So can you tell me what will be the interest of this second year? 16? How did you get? Yes, so you will first pay 150,000 rupees. This one at the beginning of the next year. Okay, so now your opening balance will be this plus interest minus repayment. Tell me, opening balance here 3 lakh something. This we had 355, 391 here. Then interest accrued during this period 17770, and then 50,000 was paid. 3 lakh, how much you said? 323. Very good. And you add 5%. 16,150, which means in 2 years time we have paid total interest of 33,928. And we are right now standing here. Okay. So for next 2 year, what is the entry we will pass? We'll pass entry for this interest This is pending in the next 2 years. We will pass entry for one more installment of lease payment, correct? And we'll pass entry for depreciation for 2 years. So what in the notes they have done, they have passed entry for 2 year interest in one entry only, but actually you have to pass two entries. You want to pass two, or you have understood? Understood, I know. So we are in India. So you write just their calculation 1770 plus 16158. Otherwise, if you keep trying, it will not happen unless you prepare that table. Okay. Lease liability. To lease liability. So one entry will be for interest accrued and one entry will be for depreciation. Depreciation account debit to right of use asset. Now here we have taken this calculation, total amount divided by 10. This will give you per annum depreciation. 2 years are over, 81,078. To right of use asset, 81,078. Okay. Now at the beginning of second year, one more entry we have to pass. Lessee would make the payment for the second year and recognize the following: lease liability account debit to cash 50,000. So can you tell me now how much will be the balance in the lessors account after this 50,000 entry? Sorry, not this 50,000. This will be the third payment. Only after this one. 339. You're right, come on. 339,319. 339,319. This will be the balance. After 2 years, the balance will be this two. Total 339,319. Because the third payment we have not yet made. Okay. Just check, is that the balance there? Okay. So after 2 years, what happened? At the beginning of the third year, before accounting for the change in future lease payment resulting from a change in the consumer price index, every 2 years they have to see what is the consumer price index. Accordingly, the lease rental will be calculated. So this is a very important question. Continuously pay attention. And making the lease payment for the third year. The lease liability today, which we have discussed also, is 339,319. Either you can get in this manner: your opening liability plus interest accrued minus payment, and there is a shortcut also. How many more payments are pending? 8 more payments are pending. So you can simply take the present value of 50,000, 5%, and 8 payments are pending. Just try on your calculator. First you will have to take 1 divided by 1.05, press equal to 8 times, and then into 50,000. $323? Oh. 7 times. 7 times and plus 150,000. 7 times you take, multiply by 50,000, and one more payment 50,000 is due now only, plus 50,000. Got it? So that is 50,000 into PV annuity factor for 7 year, 5%, and 150,000 is due immediately. Okay? Yes or no? Yes. So if that is difficult, then you follow the accounting. Either follow finance or accounts. At the beginning of the third year, the consumer price index is now 135. Oh. So now what will happen? Your lease payment will change. Lease payment will change. How the lease payment will change? Originally we had decided 50,000, multiply by current index now 135 and divide by 125. Okay, so check on your calculator. 50,000 into 135 divided by 125. Because 54,000 you are getting, which means now the calculation will be based on 50,000. 54,000. Calculation will be based on 54,000. Because there is a change in future lease payment resulting from a change in the CPI used to determine those payment, lessee remeasures the lease liability. So now again I have to calculate my lease liability to reflect those revised payment. That is, the lessee reflects now 8 annual lease payment of 54,000. Okay. So you'll have to do the calculation again. At the beginning of the third year, the lessee remeasures the lease liability to be equal to present value of 8 payment of 54,000. But the one payment is now and 7 payments are in future. Discounted at an unchanged discount rate of 5% per annum. So now you try on your calculator. Instead of 50, we'll take 54. 1 divided by 1.05. Press equal to 7 times. Press GT. Multiply by 54,000 and add 54,000. How much you are getting? 366,464. So it is the present value of total 8 payment. 1 will be paid now. 7 will be paid in the future period. So lessee increases the lease liability by 27,145. Now what is my liability before this? 339,315. Now take your calculator. Type 366,464 minus 339,319. So the liability goes up by 27,145. Now if there is an increase in the liability, you will also increase the asset value. You will also increase the asset value. Okay, so the corresponding adjustment is made in the right of use of asset. So the entry will be now right of use asset account debit 27,145, which is equal to difference between the new liability and the book value of the liability on the date. To lease liability 27,145, and then at the beginning of the third year you will pass one more entry, lease liability account debit to cash 54,000. What about depreciation? Same amount or it will change? Yes, it will change. Now you will take the revised value, divide by 8 year, and that will be the depreciation you have to provide in the third year. And this way, after every 2 year, this calculation will have to be done. Is it right? So after every 2 year, they will check what is the index, what is the liability per annum, calculate the present value of new liability minus book value of the liability, adjust the difference in the carrying amount of the asset and liability. Okay. Now one more little more complicated example now, that is variable lease rental that depends on rate. That means the rate variable payment is linked to some benchmark rate, like in this example LIBOR. When the variable payments depend on a rate, the accounting is a little different as given in the following example. A similar type of problem, but here the lease rent will be varying with the LIBOR. Entity B enters into a lease for 10 years with a single lease payment payable at the beginning of each year. Underline beginning. So be careful when you have to change. Okay, beginning of each year, the initial lease payment is currency unit 1000. Lease payment will increase by the rate of LIBOR each year. at the commencement of the lease, the LIBOR is 2%. So that means you will estimate the lease payment assuming 2% LIBOR. Because the standard says you have to assume rate, index that is existing at the commencement of the lease, 2%. Assume that the interest rate implicit in the lease is 5%, that is for discounting purpose. In accordance with IFRS, the lease payment should initially be measured using the rate, that is the LIBOR as at the commencement date. LIBOR at the commencement date is 2%, therefore in measuring the lease liability, it is assumed that each year the payment will increase by 2% as follows. So after that date, we'll make a table. Check whether this is right. Year 1 to 10 you will write. Lease payment today is 1,000 and this will increase by 2% every year. This will increase by 2% every year. So just keep adding 2%. Start. 1,000 plus 2%. 1,020 plus 2%. Is it 1,040 plus 2%? Round off. Don't write in points. 1,061. Tick mark. 1 plus 2%. 1,082 plus 2%. Plus 2%. 126 plus 2%. 49 plus 2%. 1172 plus 2%. 1195. Okay. Now discounting factor is at what rate? 5%. Check the discounting factor. 1 divided by 1.05 equal to 0.952. Now just be careful. The first payment is made now. So the discounting factor is 1. Then these factors 1 upon 1.05. Now check the multiplication first and check the total. Solve. This way you will do the accounting for rate based. Is it right? Is the total right? What is the initial liability you will recognize? 8806. Have you checked? Nobody is checking. Checked. Okay. You trust me? No. You have to check. 8806 is right. So day 1 accounting will be right of use asset account debit 8806 to lease liability 8806. And then you will make the payment. Lease liability to bank 1,000. Okay. And again next year you will draw this table. If the LIBOR changes. If the LIBOR changes. At the beginning of next year, if the LIBOR changes, you have to draw the table again. And again change in the liability, adjust in the asset. Okay. So you can imagine now your lease accounting will become complicated if they are linked to such index or rates. Anyway, the standard takes into account many possibilities. Practically, these are not that common also. The basis of any rent review, or where we are, this is pending. Rent review to market rates or upward only. Now this standard says, if suppose it says we will review the rent after 5 years, and if it increases, we will increase the rate. Will you consider such possibility in the lease payment calculation? The answer is no. Okay. So when a lease contract includes the potential for rent review, that is normally this lessee lessor says that we will review our rent in future and we will change it to the market rate or upward only. The lease payment included in the measurement of lessee's lease liability and the lessor's net investment in the lease at the commencement date will be payment agreed at inception, underline, without consideration of future rent reviews. Whether a lease specifies a rent of rupees 1,100 annually plus market increases, or CU 100 annually resetting up or down to market every 5 years, the lease payment recognized at the commencement date will be only 100 rupees annually. Any increase or decrease as a result of subsequent rent review, after 5 years you do the rent review, okay, and you make it 150 suppose after 5 years, then what will be the effect? Will be recognized when the adjustment to the lease payment takes effect, not now. So future rent reviews are ignored in estimation on the commencement date. The basis of any rent review under a lease should be evaluated carefully. Now these are application guideline to determine whether the rent review resets the lease payment to market at the date of review, or whether in substance the amount of change in lease payment at the date of the review was fixed at inception. If the lease payment will be fixed at inception, they will be considered. Okay. In the later case, the change in rent would represent in substance fixed payment. If the rent agreement says after 5 years it will become 150, it will be considered. After 5 years we will review the rent, then it will not be considered, because then it will become an in substance fixed payment only. Variable lease payment linked to future performance or use of an underlying asset. Variable lease payment linked to future performance or use are excluded from the measurement of lease liabilities. Such payments are required to be recognized. One query was asked on this topic. What about the payment entry? Will be recognized in, underline you, profit or loss in the period in which the event or condition that triggers those payment occurs. So that will be treated as an expense of that period. The following example, which is reproduced from IFRS 16, illustrates how a lessee accounts for variable lease payment not included in the measurement of lease liability. So there is an example which is actually a continuation of one of the two previous examples only, somewhere before we had covered. So good news, you don't have to do much calculation. Right? Ready? So there is a small example there. Assume the facts same as example 6.5.2.2. What was that example? That first one or the second one? First one. Okay, that was based on index, right? Except that the lessee is also required to make variable lease payment for each year of the lease, which are determined at 1% of the lessee's sales generated from the lease property. So this time there are two payments to be made. One is based on index and second based on sales. At the commencement date, lessee measure the right of use asset and the lease liability recognized at the same amount. Recognized at the same amount. What was the amount? 4,05,391. As in example 6.5.2.2. This is because the additional variable lease payment are linked to future sale, and thus they do not meet the definition of lease payment. Consequently, those payments are not included in the measurement of asset and liability. So the entry remains the same. If you look at the entry, it was passed by us some minutes back. Right of use asset account debit, same figure, 4,05,391. To lease liability, 355,391. And to cash payment, 50,000. Lessee prepares financial statement on an annual basis. During this year, the lessee generates the sale of 8 lakh unit, 8 lakh currency unit. They will pay 8,000 rupees to the lessor, which the lessee would recognize in the profit and loss account in the first year. Okay. Now next is, what about option to purchase the underlying asset? So this also we have discussed. If it is reasonably certain that the option will be exercised. Okay, and then I have given you one homework today on this point. What is the homework? What are the various factors which will influence your decision to purchase the asset or not? Okay. So purchase options are required to be included in the measurement of lessee's lease liability and the lessor's lease receivable in the same way as option to extend the term of a lease, that is exercise price of purchase option, is included in the measurement of lease liability if the lessee is reasonably certain to exercise that option. This standard uses the word reasonably certain, not 100% certain, but yes, more than say 50%, more likely that not. Okay. The standard setter views a purchase option as effectively the ultimately option to extend the lease term only. So either you extend the lease term or you purchase the asset, it would be more or less same thing. No? Let us say it's a 10-year lease. One is you can extend it to 15 year. Second is you have an option to purchase it at the end of 10 year only. So you have two choices. Either you pay rent for 5 year or you purchase it at this point and use it for next 5 year. So therefore this is also considered in the payment of lease payment. It is like you are making a one-time payment instead of installments. And it is paid to the lessor. A lessee that has an option to extend a lease for all of the remaining economic life of the underlying asset is economically in a similar position to lessee that has an option to purchase the underlying asset. So these two sentences are saying either you pay rent for remaining economic life or pay a lump sum amount at this point of time. Both of you are almost in the similar situation. So for that, whether there is an option to extend, this rental will be considered. In case if there is an option to buy, this will be considered if both of them are reasonably certain. And this also we will add in the lease payment. Residual value guarantees. So usually the lessor asks the lessee to pay a lump sum amount after some lease term is over. Okay, so that also we will add. A residual value guarantee is defined as a guarantee made to a lessor by a party unrelated to the lessor. So first thing only underline, but not very important right now. Party who is unrelated to the lessor, unrelated party. That the value or part of the value of the underlying asset at the end of the lease will be at least a specified amount. For a lessee, lease payment include amount expected to be payable by the lessee under guarantee, residual value guarantee. These two lines are different. For the lessor, the guarantee can be by any unrelated party, which may be even a lessee or not a lessee. For calculating the net investment in the lease, which we will see later, yes, finance lease for lessor is same. We can say that yes, we have studied. So once again, if you are lessor, this residual value can be guaranteed by any party to the lessor, including the lessee. But if you are a lessee, you have to give the guarantee. So it is possible that the amount of residual value guarantee can be different for lessee and for the lessor. Lessee may give zero guarantee. Lessee will say, I will use the asset, I'll pay you 5 lakh, that is included in the lease payment. You also think, I also think. What happens after that? None of my business. But then somebody else may say, I will buy this asset after 5 years at 5 lakh rupees. So lessor would consider that 5 lakh, but lessee will not. A lessee should estimate the amount that it expects to pay to the lessor under a residual value guarantee and include that amount in the measurement of lease liability. This treatment reflects the fact that payment resulting from residual value guarantee cannot be avoided by the lessee. This is again one unavoidable payment. So it is like a lease payment only, because you have to pay this amount. The lessee has an unconditional obligation to pay the lessor. Okay. If the value of the underlying asset moves in a particular way. Accordingly, any uncertainty relating to payment of a residual value guarantee does not relate to whether the lessee has an obligation. He has to pay the amount, this guaranteed amount, and therefore it has to be included in the lease payment. Instead, it relates to the amount that the lessee may have to pay, which can vary in response to movement in the value of the underlying asset. In the respect, residual value guarantees are similar to variable lease payment that depends on an index or a rate for the lessee. Either way, you have to consider. For a lessor, the lease payment include any residual value guarantee provided to the lessor by the lessee. So he will include guarantee provided by lessee or a party related to lessee. Sometimes the parent company give guarantee to the lessor on behalf of subsidiary. That is also okay. Or by a third party. Third party means neither lessee nor anybody related to lessee, but by third party who is unrelated to the lessor, who is financially capable of discharging the obligation under the guarantee. So lessor would consider guarantee given by lessee, someone on behalf of lessee, or by an unrelated third party who is capable of meeting the guarantee. Lessee will take guarantee given by the lessee. So therefore the calculation of lease payment can be different here from lessee's point of view and lessor's point of view. Now we'll see the accounting by lessee. Okay. Now for lessee, the standard does not talk about operating lease or finance lease. Okay. Only lease. And the exceptions are short term lease or lease where the lease term is less than a year, and that is an optional low value item. Short term, because this fellow is distracting me. We are not closing the batch right now, wait. So either short term lease or low value item, and that is an option also. You can use this standard if you want as it is, but normally people would not do, because unnecessary it will involve time, cost, and you don't get any benefit, because in 6 months time or 9 months time everything will ultimately go to P&L account only. So at the commencement date, actually we have solved two problems also. The lessee is required to recognize both the right of use asset and lease liability. So you will estimate what are my payments, which we have discussed 5 items. Fixed payment, in substance fixed payment, obligation to purchase, that is optional amount that you have to pay, then guaranteed residual value by the lessee, and termination option payment if the lessee is going to terminate and it is reasonably certain, minus lease incentive. Okay. So you estimate all those numbers, make a table 1, 2, 3, 4 till 10, 15, 20 years. Calculate the present value and then debit the asset, credit the liability. Okay. Recognition exceptions. 2 exceptions are there. Okay. These are optional exemption. Keep in mind, these are optional exemption. A lessee may elect means option, to apply the requirement in the standard in recognition, measurement and presentation related to short term leases, that is where the lease term is less than 12 months. You can just simply treat them as an expense and amortize it over straight line, on straight line basis, but that is we will discuss afterwards. Or the assets which have low value. If you buy suppose a small furniture whose value is 5,000 rupees, even though it may be useful for you for 2-3 years, but then keeping a track of a small value item, discounting and doing so many calculation may not be feasible. Okay, amortize it over the period on straight line basis. How to judge what is low value? This is a principle based standard. Although they have given a guideline, almost $5,000 is the benchmark, but that is not a necessary condition. $5,000. Okay. So up to $5,000 one can assume to be a low value item, but for some entities $5,000 may not be a low value item. Okay. So there is no guideline here as such. It is left to your judgment. Rough guideline is 5,000. Earlier in Companies Act in India, 5,000 rupees of an asset was treated as a low value asset. And in US, it is $5,000. But that $5,000 is not a legal number. Huh? You can ignore that and you can decide your own benchmark. For short-term leases or low value item for which exemption is applied, lease payment will be recognized as an expense over the lease term on straight line basis unless any other basis is more representative. Okay, now we will continue.